The average man watched the tape. He worried about the current price. He listened hard for the latest rumor. This focus on immediate momentum was his greatest error. Price action was merely an effect. The cause lay hidden in the calendar. The true professional understood the law of vibration. Everything in the market moved according to a precise mathematical measure. The speculator only saw the high price. He ignored the elapsed time. He chased a stock that had already fulfilled its natural cycle. The energy of the move was completely spent. This blindness to time ruined more accounts than excessive margin ever could. The public believed volume or news dictated the future. They failed to see the pre-calculated destiny of every rally. The professional did not count the points. He counted the days. Certain time intervals held immutable predictive power. These intervals were the true turning points. 90 days marked a crucial quarter cycle. This period demanded close attention from the holder of a long position. 180 days completed the powerful half cycle. This often brought severe reactions. 360 days completed the square of the year. This annual cycle represented a major shift in trend. These were not arbitrary dates. They were points of extreme, inevitable resistance. A powerful rally might smash through a resistance level, but it could never defy the calendar itself. The mathematical destiny of the move was tied to the passage of time. When price met a major time intersection, liquidation was mandatory. It did not matter how good the news seemed. The professional acted without emotion or hope. He recognized that the rally's time energy had been expended. The upward thrust had reached its predetermined term. The market was preparing to square itself. Before we continue and get to the main point, I'd like to thank you for the interaction that drives this content. If possible, take a second to subscribe, like the video if you enjoy it, and leave a comment. This helps the video reach more people, especially your subscriptions, and guarantees you won't miss the next breakdown. The market demands discipline. The average trader relies on hope. Hope is the most expensive thing on the tape. William Delbert Gann understood these harsh realities. He codified his findings in the volume Truth of the Stock Tape. This book teaches mechanical trading. It stresses the power of time cycles. It makes money management mandatory. The link to this book is in the description below video. The market obeyed a strict rule of vibration. It sought a perfect equilibrium in all things. Price and time were merely two sides of the same geometric equation. The true completion of any major swing arrived when the number of price units advanced matched the number of time units elapsed. This was the squaring of the range. It was the moment of natural balance. The upward thrust had consumed its allotted weeks or months. When the count of price points equaled the count of time units, the structure was deemed complete. The professional recognized this law. The amateur ignored this vital symmetry. He bought on hope when the move was already terminating. The violation of this natural balance always led to a catastrophic reversal. The market demanded payment for the transgression. The successful operator calculated this destination in advance. He employed the geometric angles to find the future. The Gann wheel provided the necessary coordinates for the turn. The square of 9 revealed the critical price levels. These were not random numbers. They were key prices that mathematically squared the time duration since the last major low. The speculator needed to find the exact price where the price units balanced the time units from the start of the move. This price became a magnet. It represented the point where the market's energy had been entirely expended. The level was not guesswork or hopeful wishing. It was the pre-calculated liquidation point. The market had achieved its destiny according to the law of nature. The operator simply followed the predetermined map. He sold aggressively at the squared price. The majority of traders held on, blind to the temporal law. They watched their profits vanish when the market inverted with sudden violence. The balance had shifted. The advance of any commodity is never haphazard. It follows a definite, pre-calculated route. Price must harmonize with time. This natural law defines the true rate of movement. The basic standard of movement is the 1-by-1 angle. This is the 45-degree line drawn from a significant low point. When the market holds this angle, the primary trend remains solid. A powerful advance, however, will climb at a much faster rate. It follows the steeper 2-by-1 angle. This signifies 2 units of price gained for every 1 unit of time elapsed. That is the path of a strong, determined rally. The professional operator watches this geometric structure closely. The governing angle defines the speed and the destiny of the advance. It must hold the price above it. This geometric map dictates the market's future. If the price action weakens, it will invariably break below its ruling angle. This signals a fundamental change in the mathematical destiny of the move. The structure is compromised immediately upon that break. The speculator must recognize this failure without delay. Hesitation at this point is simply gambling. If the market breaks the 1-by-1 angle, it will search for the next, shallower support. It targets the 1-by-2 angle next. That line offers only half the support of the standard rate. The trend has slowed down fundamentally when this redirection occurs. The great force driving the advance is gone. The market seeks a new, slower equilibrium. The time to sell is when the primary geometric line is crossed. It is a clear signal that the rally structure has been compromised. The professional does not wait for confirmation from news headlines. The market always respects the geometry of its own structure. Price cannot long remain below the angle that once supported it without inviting a deeper correction. The destiny of the rally is determined by the angle it holds. The market respects geometry even in its minor movements. The movement has a measured destination. That destination is fixed by mathematics. The professional trader knows that price does not move arbitrarily. Every major swing range contains the key to the next reversal. The rally's destiny is written in the fractional divisions of the previous decline. The market respects these natural points of resistance. They fall at the 1/8 and 1/3 divisions. The speculator must calculate the precise range from high to low. These calculations provide mandatory turning points. Price often fulfills its immediate obligation at the 2/3 level. The most powerful resistance, however, is the 1/2 point. 50% retracement is the great dividing line. Failure to cross this level confirms the strength of the prior trend. Crossing it suggests the beginning of a truly major reversal. The average speculator ignores these fixed targets. They wait for arbitrary round numbers like 100 or 200. Greed keeps them in the trade too long past the point of safety. They demand the absolute top tick. The market rarely rewards such excessive patience. It punishes those who ignore the law of fractional resistance. The professional calculates these levels beforehand. They treat them as fixed targets for profit-taking. When the fractional level is reached, the immediate rally has fulfilled its destiny. The speculator must understand that prices move from one fractional point to the next. The market dictates when the trade is complete. It is not determined by the speculator's hope. The wise man exits the position at the calculated resistance. He does not wait for price to turn back from the ordained level. He locks in the profit and waits for the next setup. The short swings are merely echoes. The true power lies in the great cycles. The speculator must measure time as carefully as price. Long-term success demands a grasp of history. Prices do not simply forget where they came from. They are destined to repeat their movements. The great turning points are marked by powerful time measures. Observe the 30-year cycle. It often signifies the completion of a major trend. It marks a significant generational shift. Few speculators survive 2 or 3 of these massive swings without being wiped out. The 60-year cycle holds the ultimate key. It is the master time factor. Ignoring this measure guarantees ultimate failure near the peak. The fool looks only at the present excitement. He buys the greatest volume near the top of this massive swing. He believes the rally will never end. The wise speculator studies the past. He maps the historical pivots of the last 6 decades. He seeks the repeating pattern of time. He calculates the exact price level that aligns with the completion of the major cycle. This alignment confirms the ultimate mathematical destiny of the move. When the long-term position approaches this calculated resistance, action is mandatory. The speculator must liquidate everything. He does not wait for the tape to show weakness. The time factor has already determined the turning point. The cycle is complete. The powerful vibration has reached its apex. The market then begins its long, painful decline into the next major time window. The same rule applies to the shortest possible moves. The market does not abandon its geometric laws simply because the action is fast. Time governs the minute-by-minute trading just as it governs the years. The novice watches only the tape. The professional speculator watches the clock. Intraday turning points arrive with mathematical precision. These specific time counts dictate the destiny of every short rally or decline. Critical moments occur when the market completes a degree of time. 90 minutes from the opening bell is always a potential pivot. This marks 1/4 of the full rotation. A full half rotation often arrives at 180 minutes. The 360-minute count defines the completion of the full daily cycle. The amateur chases momentum. They see a strong push lasting 45 minutes and buy aggressively. This is precisely when the short-term rotation is due. That rally has fulfilled its destiny on the clock. It must now reverse course to clear the weak speculators. The market delivers a sharp whipsaw. The momentum buyer is instantly trapped at the high price. The professional charts the market using these small units. The 45-minute chart is essential for anticipating intraday reversals. The 90-minute unit confirms the major short-term pivots. The speculator knows the market is merely rotating through these measured time degrees. The position is liquidated based on the clock, not on weakness seen in the volume. Anticipation replaces reaction entirely. When the time count indicates a reversal is mandatory, the speculator stands aside. The clock defines the exact moment the powerful move must stop. It is the only true measure of market strength. The speculator looks always for geometric confirmation. The clock defines the mandatory moment of reversal. The angle defines the path of least resistance. Every powerful advance rests upon a mathematical line of support. This line is often the 1-by-1 angle, or perhaps the steeper 2-by-1. If the price maintains this angle, the upward destiny continues. A break below this vital angle signals serious trouble. The mathematical structure of the rally is immediately challenged. The strength has been compromised. The market seldom gives up its gains easily. It returns to the scene of the break. The speculator watches this return with cold patience. The broken angle line now acts as resistance. It is the crucial point for true confirmation of the failure. The market attempts to climb back above the line it just lost. If the price fails to regain and hold that old support, the reversal is confirmed. The upward energy is spent entirely. The termination is absolute. The astute operator acts immediately on this failure. The short position is placed precisely at the moment the angle rejects the price. This execution is mathematical, not based on fear or hope. It confirms that the geometric structure has been irrevocably terminated. The path is now open to lower prices. The market is destined to seek the next lower angle of support. The power of the advance is finished. The confirmation must be geometric. The retest failure assures the professional that the trend has reversed its measured course. The speculation is purely based on the angle's rejection.